Welcome to Keys Open Doors. Today we're breaking down the hidden interest rates that shape the housing market. Look, if you're an aspiring homeowner staring at today's financial data, trying to figure out exactly when to buy, or maybe you're just wanting to finally demystify how real estate finance actually works, well, you are in the perfect place. We're going to take a totally objective look at the underlying market numbers that quietly dictate the true cost of buying a home. Let's dive right in. Here is our roadmap for today. We're going to cover the interest rate ecosystem, short-term versus long-term rates, the prime loan rate, the 10-year yield compass, your home buying power, and finally, navigating the market today.
All right, Section 1, the interest rate ecosystem and market currents.
You know, navigating all this financial jargon can feel incredibly overwhelming, especially for first-time buyers. I hear it literally all the time. But think of it kind of like this. Interest rates are like the weather. You absolutely cannot control them, but you can dress appropriately. Many buyers mistakenly think there's just one single entity sitting in a dark room somewhere setting standard mortgage rates for the entire country. But nope, mortgage rates are totally organic. They're influenced by broad, underlying market currents. So just like you'd grab an umbrella before a big storm, we want to learn how to read the financial weather so you can prep your budget for sure. When we talk about interest rates, we have to recognize the background financial numbers create this massive ripple effect. These aren't just abstract figures floating in the ether. They create real waves that eventually wash right up on the shores of the housing market and directly hit your monthly payment. It all kicks off at step 1 with foundational base market rates. These are the huge institutional currents trading in the background of the global economy. Those rates then flow right down to step 2, which dictates how much it actually costs the banks themselves to borrow money. And finally, that cost flows down to step 3, which ultimately shapes the actual mortgage rate quoted to you, the home buyer. Simply put, if it costs the bank more to get money, well, it's going to cost you more to borrow it. Moving right along to Section 2, short-term versus long-term rates and understanding the difference. So not all interest rates do exactly the same job. Short-term rates are kind of like fast-moving currents that immediately impact your everyday consumer debt, things like credit cards and auto loans. On the flip side, long-term rates are much slower, steadier currents based on long-term market expectations. And this is what truly matters for a standard 30-year fixed mortgage. If you're looking to buy a house, you absolutely need to understand that these long-term currents are the ones driving the ship. Section 3, the prime loan rate, which is our short-term current. All right, let's look at our first specific benchmark today, 6.75%. This is the current prime loan rate. When you turn on the news and hear commentators buzzing about rates being up or down today, they are very often referring to foundational, short-term, daily market figures exactly like this one. It acts as a major baseline. Let's translate that jargon into plain English, shall we? The prime loan rate is basically just the base rate that banks use to price short-term business and consumer loans. In general, that 6.75% is what banks charge their absolute best, most trusted corporate customers. And since everyday consumers naturally carry a bit more risk than a massive corporation, your credit card or personal loan rate is usually going to be built right on top of this prime rate. Basically, it sets the floor for short-term borrowing. Up next, Section 4, the 10-year yield compass, our long-term current. Now, if you want to know exactly where mortgages are headed, this right here is your true north, 4.56%. This represents a benchmark called the 10-year constant maturity rate. It's a specific daily long-term benchmark that acts as a super crucial indicator for the entire housing market. So, what exactly is a yield, and why on earth does it matter to your dream home? Well, yield is simply the return an investor expects on a security over its time to maturity. Think of it this way. When investors lock up their hard-earned money for 10 long years, they demand a certain percentage back to make it worth their while. That 4.56% isn't just some arbitrary price set by a random bank manager. It represents the collective expectation of the entire long-term global market. And here is exactly how we connect the dots for you. The 10-year yield acts as a sort of secret compass for 30-year fixed mortgages. Why? Because most homeowners either sell or refinance their homes within about 10 years, meaning the 10-year yield perfectly mirrors the actual life cycle of a standard 30-year home loan. So it's pretty simple. When that 4.56% long-term yield goes up, you can safely bet that average mortgage rates are going to follow closely right behind it. Section 5, your home buying power, bringing it home. Let's bring this right down to the micro level of a single family's monthly budget. 5.07% is a current 30-year long-term benchmark rate. Notice how it sits just a bit above that 10-year compass we looked at a minute ago? This 5.07% represents the broader current environment for long-term borrowing. It's essentially the foundational institutional baseline for 30-year money in the market right now.
But hey, we definitely need to pause here for a very important reminder. Market averages exist, but individual rates vary. Always consult a licensed professional. Remember, what we're exploring today is purely objective educational data. In general, while these are the market's foundational numbers, many buyers will see variations based on their own unique financial profiles. Things like your credit score, your down payment, the exact type of property you're buying. All of these add customized layers on top of that base rate. A licensed mortgage professional is quite literally the only person who can quote you exactly what your personal rate will be.
And finally, Section 6, Navigating the Market Today and Your Next Steps. I really want you to feel empowered by this educational information in your home buying journey, rather than totally intimidated by it. So here's your game plan. First, understand base rates. Knowing that numbers like the 6.75% prime rate impact short-term debts helps you better plan your credit card and auto loan strategies. Second, monitor long-term yields. Keep a close eye on that 10-year compass, because it tells you exactly which way the mortgage winds are blowing. And finally, always consult a licensed professional. Knowing these benchmarks makes you a highly informed consumer for sure, but it doesn't substitute for personalized financial advice tailored specifically to your life. So, you've got the map, you understand the currents, and you know how to read the financial weather. The only thing left to ask is, are you ready to unlock your financial future? Keys open doors, helping you unlock your path to homeownership. If this helped, like, comment, and subscribe.